clients like there's no tomorrow.
Hello everyone, welcome to the course. Today we will continue with pricing of mortgages. Today is important block because today we will connect what we have learned before about refinancing incentive, prepayments of our clients, and also different type of mortgages. So objective today is to connect these two, so refinancing incentives and the mortgage payoff, so the mortgage contract, in order to construct a payoff that will be sensitive to both. So today we have 3 points. First is a constant prepayment rate subject. This means that we would just look from perspective that people or our mortgage portfolio people pay with some rate. So that will be simplified case where we relate mortgage to amortizing swap without really uncertainty on the decaying in some stochastic way of the notional, of the outstanding notional of the mortgage. Then we relax that assumption and we go into the pricing of index amortizing swap. So this is a case where we include stochasticity, where people will decide whether they prepay or not, depending on the market circumstances. So we have learned before that people typically, when they decide whether to prepay or refinance their mortgage, they'll be looking at particular swap rate. This information about whether they are willing or not, this has to be included in the payoff, and that will be basically associated with this contract of index amortizing swap. And then this will be, of course, linked to the point 8.9. So we will put those two concepts together. So the over-the-counter derivative of this index amortizing swap and the refinancing incentive. And at the end, we will arrive at the contract that will be available in the market to some extent, and also would allow us to include information that we have learned from our clients about their willingness to perform a refinancing or do prepayment of their mortgages. Since we have established a sigmoid function for refinancing incentive and also the benchmark being a swap rate, the next step is to link those two observations into a derivative pricing. So this is what we are going to do in this block. So we are looking for a mortgage portfolio and we are linking to amortizing swap. We have discussed already the concept of swap in the previous lecture. Now, since we have a portfolio of mortgages, this is our objective here. We have, by design, the notional of this portfolio of mortgages will be amortizing in time, because people who have mortgages, they'll be paying back the outstanding notionals. So this means that the amortization will take place in the swap. So this is extension of a swap we have discussed in the previous lecture. Now we extend it with the concept of amortization. And of course, this amortization in the simplest case can be deterministic. So this means it is just a deterministic function known today. This is associated also with the concept of a constant prepayment rate. This is the CPR, where we estimate our prepayment rate given some historical data. Then it's just deterministic number. And also we will move forward to extend this concept of a prepayment rate. It's a stochastic function of swap rate. That will be much more advanced. This is actually the ultimate goal of today's lecture. Okay, so the first step, in order to collect together, because we have discussed so far bullet mortgages, annuity mortgages, and of course we have also shown that these concepts of mortgages and everything, the difference, especially if we talk about fixed rate mortgages, it's about different amortization schedules. So our payment schedule for our mortgages, whether we pay our notional at we pay refinance or no, sorry, we repay our mortgages in a given times, and that's basically the main difference between different mortgage types. So we have a bullet annuity. We can essentially define a function here, psi. Psi is a function of lambda, and to connect these two mortgages, we can just define the following function psi. So if you just go back to the definitions, how those notionals were changing in the bullet type case, and also in the case of annuity mortgage, then you will find the following correlation that notional at the next payment date will be equal to the notional at the previous step or today's step. So the TI, it will be equal to TI minus 1. And then we have this multiplier function, which is psi, and this is a function of a prepayment rate. And then this is defined here. So of course, in a bullet case, we only have prepayment case. So we don't have any reduction because of the, we don't repay our notional. So it's only the prepayment part. And of course, in the case of annuity, we also repay our outstanding notional. So our payments are always the same, and we always reduce the outstanding notional. And this will be this representation. So this is easy to be checked by proper substitutions, that the notionals for the bullet and also annuity can be represented in this way. And this is, of course, in this way, it's kind of handy because we can, by using this generic formulation, we can price both of the mortgage types in one, essentially one formula. We are looking today from perspective of a bank. So we are owning a portfolio of mortgages, and we are interested in hedging that portfolio. So how this would look like, we will have the natural connection between you, if you buy a mortgage, and multiple people buy mortgages. Financial institution would hedge that with a swap, or in this case, amortizing swap. So bank would receive a fixed rate. So this is something that you pay to the bank, and bank will also, from the other side, we have a float payment, so the LIBOR payment, and this is the definition of amortizing swap. So we have a lifetime, so you see that we iterate from I to N, we have a lifetime of the mortgage portfolio, then we have amortizing notionals, all those mortgages that we put together, and then we have this swap where we exchange fixed rate for the float rate. Of course, here it's a receiver strike, it's a receiver, because the bank would receive these payments from clients, and the bank would need to pay the float rate. And this is how this typically would be configured. Of course, already we have mentioned that if you issue a mortgage, typically banks or financial institutions in general, they would finance those mortgages in a short term. So you would have, like here, we would have a 3-month, let's say, LIBOR rate. However, the outstanding notional, the mortgage that you will receive, it's, for example, for 10, 20, or 30 years. So here, the most important part is that we have this notional at TI minus 1, and we have a payment at TI. So this is slightly different. So this is something to keep in mind. We discount, of course, with time TI, because this is the payment date. However, the notional is established at the previous iteration step. Yeah? So this is the notional that we had before, and now in the new time TI, we will pay that corresponding notional. Then we also have accruing period. So this is also important. In the Python experiments, we have discussed this accruing period was equal to 1 because for simplicity, but in practice, this would be corresponding to the frequency of your mortgage payments, for example. But of course, in the case of a large mortgage portfolio, then this would be established, the frequency of this would be established based on a whole configuration, whole set of different mortgages. So depending on that. But typically, of course, people pay mortgages on a monthly basis. However, we will also discuss that it's not only about houses, it could be also some other real estate or flights, planes, or other valuable assets. So here the notional will be given as we have just defined in the previous slide. So we have NTI, and this is this iteration part where you have this multiplier of function psi, and then we have this prepayment rate, which is a function of time. Of course, now we call it constant prepayment rate, so we can fix the prepayment rate not to be time dependent, just to be constant. But as you can see, it doesn't really matter here, because if something like this function psi, it is time dependent. For calculation of expectation, it doesn't really matter. What matters is the stochasticity. So if we have psi, which is depending on a stochastic factor, which could be possibly correlated with L, so the LIBOR rate, then this really complicates the matter, and you will see in a few slides what is the issue with this kind of relation if you have stochasticity inside. However, in any case, if you have a prepayment to be deterministic, it's really not a problem whether it's a constant or deterministic function. What is, of course, a problematic part is that you need to establish this prepayment rate using, of course, a much richer data set if you like to have a prepayment as a function of time. So this means that it's easier to estimate prepayment rate as a constant. So you can just estimate given all your data, historical data of your clients. But of course, if you like to have it established as a time-dependent function, then you need to develop much better and accurate procedure to get that prepayment rate. And of course, now, because we define this N to be time-dependent, so it's an amortizing swap, so then we talk about pricing of amortizing swap, so it's AS, amortizing swap. This is how we can see these cash flows. So we have seen similar figure for pricing of a swap. Of course, in the case of a regular swap, those notionals on a fixed side, they were constant. So because we had only one notional, of course, because it's amortizing, there will be a decay of the notional. Of course, it doesn't mean that this decay will be like here, that it's linear decaying. We already have seen in the case of amortizing swap that this decay may not be linear. It's linear only if the prepayment rates are close to zero. If the prepayment rate increases, this will be much more exponential type of shape. So we have we receive on this side and we pay on the float side. So this is the illustration, and here we have the pricing of the amortizing swap. So it's the same as before. We have the notional we paying at time ti, we discount from time ti, and the notional is established at time ti minus 1. And of course, we need to take the expectation. So this will be the illustration of this amortizing swap. So if we look at the pricing, how this could be performed, so we start, of course, with the calculating of the expectation. First thing, this is deterministic. So in a constant or time-dependent prepayment rate, this is deterministic. Doesn't really matter for calculating of expectation. So expectation can go under the summation sign here. What we do is the following. Exactly as we have done it for a pricing of a regular swap, we change measure from, because it's a summation, so we can change for each summation element to the TI forward measure. This is what we do here. Then of course, notional doesn't really is affected by that. We have the zero coupon bond TI corresponding to the payment. And then here we have expectation under TI measure of the LIBOR TI minus 1, and TI. Of course, this is what we have also seen before. This is a martingale. Since LIBOR is a martingale under pay measure TI, this is established basically to be a LIBOR L T0 TI minus 1 I. And of course, this is also defined in terms of zero coupon bonds, so we can substitute that. And this is the pricing expression, what we will get for pricing of amortizing swap. So we see it's very straightforward. This basically very much alike what we have seen before for the in the case of just regular swap. Here's something to keep in mind, that this notional that is amortizing, then you may not arrive at the nice cancellation of the terms if you talk about the harmonic summations of the elements, because those elements will be multiplied by different coefficients. So this is something to keep in mind. So this is not as, let's say, it doesn't collapse to a very elegant formula as we had the case for the interest rate swap. And of course, this is a trivial case where we have time-dependent function for prepayment. The extension, of course, would be to make this function to be stochastic. Now, of course, we have already shown that this lambda, this prepayment, will be associated with a swap. So if you have a mortgage, you'll be looking at the swap rate in the market, and then you'll be comparing your mortgage rate that you have received from the bank, you're comparing that mortgage rate to the rate that you would see in the market, would be swap rate. And of course, this extra compensation, the liquidity risk coefficient that is tarred on the top. So of course, this means that this lambda function, lambda ti minus 1, will be in some sense a function of swap rate. Of course, given, of course, that we also have to incorporate this rationality effect, this sigmoid function that we have also seen before. Okay, so by letting the notional n to depend on interest rates, so this is what we will do next. Actually, here we have RT, but we will make it dependent on swap rates. We will establish a clear link from a market simulation to the impact of prepayments on a mortgage portfolio evaluation. So, of course, if we have this stochasticity, then we will have much more realistic case where we know that clients may behave irrationally. And also we will incorporate this element that they'll be observing certain rate in the market, and that will be incorporated in the pricing of this amortizing swap. The stochastic prepayment rate lambda will no longer, we will no longer deal with a standard amortizing swap. So if we have a function, so if our notional is in some way a function of a stochastic quantity that you have here observed, for example, a function of LIBOR or a swap rate, then we are not talking anymore about the standard amortizing swap, but then we have to deal with index amortizing swap. So this is over-the-counter derivative. This means that it's not derivative that you can simply buy in a market. It is something that you can request from a bank to create this kind of exotic derivative in order to hedge this type of risk. So, of course, if we have this notional to be a function, or the complicated function in some sense of swaps, then of course this is not anymore standard approach to price it. You cannot simply decompose it in a linear set of swaps. Then you need to ask advanced counterparty like banks or other financial institutions to create this kind of derivative for you. Today, however, we will be looking more from perspective, okay, we could look at this, we can look in the market to hedge, to get this index amortizing swap. But today we will look from perspective how to mitigate that and represent this, let's say, index amortizing swap as a function of swaptions, because this is also something that we can think. Because if we have some kind of optionality in our payoff, we can always try to map that kind of optionality into pricing of options, European options. And this will be the objective of a later part of this lecture. So we will start with index amortizing swap, and I will show you how this can be linked to pricing of swaptions. Something to keep in mind. So what's the problem? The big problem with the pricing of stochastic notional. So we have this notional here in amortizing swap, which was deterministic because it was just a deterministic prepayment rate. But what happens if we have stochasticity? And there's a big issue here, actually. So this step where we have the composition of this notional cannot be anymore taken outside of this expectation, because here was the deterministic case, then we have actually a problem. So this is not anymore as beautiful as we had it here in a derivation in usage of a T-forward measure. Let's take a look. So if we have a LIBOR, so we have this LIBOR rate, we look at the pay date of a LIBOR rate is TK, and we have a measure, corresponding measure is TK, then we know, we have seen it before in this course, that this would be equal to the LIBOR rate times T0. This filtration is T0, so if a LIBOR rate times T0. However, if, for example, you have a square here, so this is important, so it's not anymore just a LIBOR rate, but it's a square, then this doesn't hold anymore. So this is not anymore the case that we could say, okay, because LIBOR is a martingale under TK measure, then LIBOR squared will be also martingale. This is not true. So this is very, very important. And how to see that this is not true? What we can do is simply take the dynamics for the LIBOR rate under the TK measure, so this is a pay measure. We know it will be a martingale. We apply Ito's lemma to LIBOR squared, and you will see that actually we have a drift element that pops up. So this drift element implies that this will not be the case, that this will be equal to this. So this will be only the case if this term here would be 0. Then we can indeed say that the LIBOR squared, expectation of LIBOR squared, will be equal to the initial of LIBOR squared, but that's not really the case. So this is the same, this will be equivalent case as we have here, because we cannot really, if n will be depending on prepayment rate, which is a function of a swap rate or any interest rate, we cannot really decompose. We cannot take this expectation of the product of the two if not equal of the product of expectations, because obviously if we have LIBOR here and we have some kind of dependence on a swap rate is also a function of this LIBOR rate. So this means we cannot simply decompose that. So this is only one term. So then we have one term of a product of two terms. So this means we cannot simply get this solution as we could get here. So this is something that we have to keep in mind, that pricing, if we have any of these factors that we have seen in the notional, or we would, for example, K or not, maybe K not, but if we have accruing, whatever factor here would become stochastic, then this nice measure transformation, it's not helpful anymore. Always keep in mind what quantities are martingales, and if you see somewhere squares or you see a function of that LIBOR, then you always alerted. First think of, okay, let's apply Ito's lemma, and then let's verify whether indeed the quantity that we are observing is a martingale or not. So this would be a serious mistake if you would just do L squared, because you'll be missing the whole drift term, which is here, in this case, will be a function of volatility. So this is rather significant, and this is also possible that you have a bug in your code and you'll be really struggling to find out what is the reason for the mistake in your evaluation. It is important to notice that if you would have a mortgage with a floating rate mortgage, so this means that our monthly payments will not be predefined in the beginning when the mortgage is bought, but it will be a floating rate that we see in the market, then the problem of prepayments will not really exist, because in that case, there will be no real incentive by looking at the market to really to benefit from that by prepaying at the lower rate. So this means that the prepayment risk essentially only exists if we deal with a fixed rate mortgages, where the mortgages are fixed at some, let's say, old rate, and client looks at the market and sees, okay, the market circumstances are beneficial for me to perform prepayment or not. In the case of a floating mortgages where the rate is a float, then this incentive does not really exist, because always we have, let's say, the the money trade. This means there is no really benefits of prepayment. Of course, this is only the case when we talk about mortgages or prepayment based on the refinancing incentive, when the decision is purely made based on an interest rate in the market. Of course, if you have some lump sum you have received, you bought, you won lottery, or you just would like to prepay, this doesn't really matter whether the rate is a float or it's a fixed, because you just want to prepay your mortgage. But of course, that may be not optimal, of course. So let's summarize what we have seen about those mortgages and also index amortizing swaps. And the next step would be to link the index amortizing swap contract to the prepayment rate, and the prepayment rate link it to the market observable quantity and swap rate. Meanwhile, using also the refinancing incentive function, which we already have discussed, is related to the rationality of a client. So see, there's many different elements we would like to put together to price essentially mortgage portfolio. So, but before we go to this whole process of putting all those elements together, let us just concentrate now on principles behind the index amortizing swap. So, okay, so from the interest rate perspective, the fixed rate loans contain prepayment risk. So this is what we have just discussed. The mismatch between the pre-agreed mortgage rate and the in-the-money market rate would be just zero. Of course, because every time there'll be old rate will be always equal to the new rate. So this relation of K equal to kappa will always hold for every time T. Interest rate swaps are not contractually linked to the mortgage loan. So this is also what we have seen, that if we have a prepayments, then we cannot really link it to the to the swaps, because there is some stochasticity involved in the notional that is going to be affected by the prepayment of clients. And here we have one more thing. The fixed rate loans are therefore usually hedged to reduce interest rate risk. And connecting mortgages with interest swap achieves this. This is also this amortizing swap that we have just discussed, and also the linkage to the index amortizing swap when the notional the prepayment is linked to the observable quantities. Okay. The index amortizing swap is over-the-counter interest rate swap that is in a combination of a plain vanilla swap and partially a swaption. In essence, when you think about index amortizing swap, think about an amortizing schedule, which is defined or indexed with respect to underlying asset, like, for example, a LIBOR rate. So notional, it is defined as a function of some index. It's not an amortized, predefined that you would have an amortizing swap, but it will be just a function of some market observable quantity. And that makes it exotic over-the-counter derivative, because, as you can imagine, those relations between notionals and different type of indices, this combination is very rich. So you may choose from many different indices. So of course, this is becoming very much exotic derivative. And to get this exotic derivative, you need to really contact financial institution to create this derivative for you. As we already have discussed in the course of computational finance, those exotic derivatives, those are typically designed for sophisticated investors. So you cannot simply buy on a trading platform this kind of derivative. It is typically involves large notionals, and it's and requires also quite some effort to perform proper hedging and monitoring of all the risks that they are included. This type of exotic derivatives, they are not discussed in this course. We will discuss, focus a lot of attention on exotic derivatives, callables and non-callables, many others, but this will be covered in the follow-up course. In this course, we mainly focus on building a portfolio for XVA. Okay, of course, just to mention also that mortgages, as we discussed in this lecture, they are not going to be, in practice, they are not included typically in XVA evaluations. So this is different aspect of it. However, the whole concept of pricing of mortgages, looking at the refinancing incentive, connecting the prepayment, the market observables, so linking P measure and Q measure, I think it's very fascinating, and it's definitely worth to spend some time on it. Amortizing swap with a deterministic amortization scheme are commonly traded instruments. This is already what we have discussed, because this is a linear instrument in terms of LIBOR rates. So this means that we can easily decompose those amortizing swaps in terms of a very simple LIBOR rates, and then we can, of course, replicate completely the amortization part by just adjusting the notional for individual payments. So that's rather trivial. Peculiarity of the index amortizing swap, which is the hybrid, is that amortization scheme is predetermined as a function of specific interest rate. So, like I mentioned, the notional is indexed with respect to some interest rate, which is observable in the market. That makes it stochastic, and that makes it much more difficult to price. And of course, because we have this kind of relation, non-linear relation, then index amortizing swap, you can consider to be very similar to pricing of an option on that rate, because it's also related to this expectation I have shown you in a previous block, where we can, those martingality properties, they don't really hold if we have a more advanced, more complex notionals in a payoff valuation. And the last point here, index amortizing swap and a mortgage portfolio share the same, they share essentially the same embedded optionality, enables to fit the mortgage portfolio to index amortizing swap. This is also what we have already seen, that the natural feature that our notional of the portfolio of mortgages is amortizing in time, it fits, and also there's a relation to stochastic factor. It nicely fits to the concept of index amortizing swap. So we want to, of course, establish the link. So we want to put all those incentives, swap rates, all sorts of risks, all these observables that we see from the client's behavior to the definition of index amortizing swap. So, of course, the payoff that we will have is the one that we already have seen. The notional, it will be a function of prepayment rate. Prepayment rate will be a function of our, of course, swap rate. And also we will have included there our refinancing incentive. So this will be also the function which is determined historically based on the client behavior. And here maybe there's maybe something else to be added here. So even if our model considers only a refinancing incentive as a driver of prepayments, this will not lead to fully rational model because a smooth function form for lambda will be preferred over the step function. So this is again the connection, how this refinancing incentive, how the sigmoid function can be included in the amortization of the notional, of course, as a function of a stochastic quantity we observe in the market, so the swap rate in this case. Our objective is to evaluate a variation of index amortizing swap where the notional is based on the prepayment rate. So in this case, it won't anymore the standard index amortizing swap. We will have indexing will be with respect to a swap rate, or other market instrument like a LIBOR rate. In our case, we want to define this amortizing based on a prepayment rate. So the prepayment rate will be itself as a function of a swap rate. So this was maybe a graph, a little bit of, without going too much details, how exactly the cash flows between financial institutions linking look like. So we have a mortgager that will pay a fixed rate mortgage to financial institution. And additionally, there will be a prepayment rate. Then the financial institution would, if we would have no, let's say, this index amortizing swap, then a financial institution would hedge those. The financing would take place via swap, amortizing swap. And of course, the problem there would be that if we have some prepayments, that clients prepay the mortgage, then of course that potentially that could be a loss for the bank, because client would always prepay in a scenario when it's beneficial for the client. However, bank would have then exposed position because there's some risk that bank took when there's a swap transaction. And then what we can do there, we can offset that by entering this index amortizing swap, where the prepayment will be included in the notional schedule. So the notional will be adjusted according to the prepayment rate, and that would facilitate the whole relation between the swap part that the financial institution would hedge in the market, and the remaining could be handled by index amortizing swap in the over-the-counter. Then, of course, in the index amortizing swap, we still have to define the prepayment rate, which will be a function of the float rate observed in the market. And then the final part related to index amortizing swap is, of course, is that the challenge is the modeling of the notional of the index amortizing swap, which embodies the possibly stochastic amortization via an involved function of the type of a mortgage. So this n, of course, we already have presented before. It will be this function of a mortgage type, because we also have this psi. So depending on it's a bullet, annuity, or other type of mortgage, then this will be much more involved. Then, of course, we have a relation to the history of prepayments, because we need to establish historically or client behavior, whether what is the likelihood of prepayments, whether client is likely, or what is his rational incentive to perform a prepayment. Of course, there are many other factors that you could also include in the estimation of the refinancing incentive, of course. And this will be the payoff that we have seen. And the final point here, the notional of index amortizing swap at time ti is assumed to be the notional of the mortgage at time ti minus 1. So this is, already have discussed that. The prepayment rate, this lambda function, ti, is denoted as one of the dependent arguments in the notional. So this is just the formulation of index amortizing swap. In this lecture, we assume that refinancing incentive is only the main driver why client decides to prepay his or her mortgage. Of course, in practice, this is much more involved, and there is a lot of studies done on how to assess client willingness to perform payment or prepayment of the mortgage. As we already discussed before, there are many different factors, like, for example, age, client wealthiness, salary, income, inflation, all those factors that play a very important role in client willingness to prepay the mortgages. Of course, also the important one would be paying the taxes, the different tax rates, etc., etc., etc. So this is a rather involved process. Of course, here we don't want to focus so much on all these possibilities. Here we concentrate, in this lecture, we concentrate on the main factor, so-called refinancing incentive, where we assume that the client, person who got a mortgage, will only look at the one factor, which is the market observable quantity, which is the swap rate that would correspond to his or her current mortgage. Okay, so now we have to put all those ingredients together in order to price, to define index amortizing swap. So how to define the mortgage portfolio where we have all those different ingredients related to refinancing incentives, swap market, swap rates, notionals, the error, of course, the difference between the swap rate, the current mortgage, and the swap rate, etc. So this part we will concentrate on putting all those ingredients together in order to essentially simulate notionals and stochastic quantities of observables in the market. So okay, so we assume that our prepayment rate is a function only of the refinancing incentive. On the refinancing incentive, it is a function, of course, it will be depend, of course, here we have refinancing incentive. We have two cases. We have a fully irrational model. So this is the one that we have already seen before. So this is a step function where client decides when the observable quantity, so we have this error here, which is defined. So the error at time ti is defined as client's old mortgage rate minus kappa ti. So it's a new mortgage rate. And this is the error. And of course, client will, the rational optimal, will always switch or always prepay with certain prepayment rate once this condition is satisfied. Once it's attractive for the client to perform prepayment, immediately once this opportunity appears, then client will behave rationally. Of course, this is not really realistic. This is only, let's say, an extreme case when people would behave in this way. In a realistic way, we would have a function which is much more of the S-shaped function. This is what we have seen, sigmoid function, where it is defined in this way. So you see that we have those coefficients alpha 1, alpha 2, alpha 3, and alpha 4. So this is a logistic function. And here it also depends on this observable epsilon time ti. And here also those coefficients. So this is what you can think. So although we have this epsilon at time ti, so this is every time where we we pay our mortgage, we'll be comparing the market rate versus our own mortgage. We include this, let's say, incentive case, but we also have those coefficients functions alpha 1, alpha 2, 3, and 4. Those would need to be estimated from historical data or the pool of clients. Of course, we as a bank, we don't know each individual client's coefficients. Yeah? We don't know whether one client, what are his values for those coefficients. So those coefficients will be based on the whole large portfolio of mortgages, and then bank, of course, the hedging and the risk management would take place on the large portfolio scale, not in the case of individual mortgage only. So those functions, this is whole studies done how to estimate those coefficients alphas. You see here is alpha 1, 2, 3, 4. Of course, you can also have those alphas to be time dependent, which adds also additional degree of freedom. And of course, yeah, those estimations is a really big study how to estimate. And of course, each individual bank would have different preferences regarding the clients. So there is no really one uniform way how to find those coefficients, because everything is determined by the pool of clients that you have in your portfolio. Of course, if you are a small bank without a large pool of mortgages, then it's much more difficult to estimate those coefficients. Then those functions are much more, those coefficients are much more, let's say, guesstimated, or rough estimations are given. If you have a big portfolio of mortgages, a lot of historical data, then you may expect that you will have a better estimation for those coefficients. But of course, let's also be realistic. Those functions, those coefficients, are not market driven. Those are just historical estimations of the clients. It's not really really true. It's not something that we can simply hedge in the market, because we don't know how people behave. And of course, we use only historical data. This means that in future, there could be an additional factor that would change refinancing incentive, but it may not be present in historical data. So this is something to keep in mind, that historical data is not, it doesn't have all the information about the future. So historical data only shows you how historically people behave. It doesn't really tell you how future will be, how people behave in the future. So this is something to keep in mind. So here we have very important. We have this lambda. So prepayment rate would be a function of refinancing incentive. A refinancing incentive, it's a function of how clients behave. So we have two options. We have rational and also the realistic, the logistic or sigmoid function. So you see this function is actually here. So of course, now the next step is how to include those two functions, or lambda as a function of refinancing incentive, how to include this in our index amortizing swap. So definition of index amortizing swap. First step, we take the notional. We use the notional as a function of particular mortgage type that we have. So we have this function psi, and then we have in our lecture, we considered only bullet mortgage, also an annuity mortgage. But of course, this amortizing schedule, you can change according to the mortgage of interest you have. Of course, here we also assume that we have a product, but you can also extend it to summation, whatever you want to have. In our case, it was beneficial to consider just a product, because that's two mortgages nicely fit to that. Then we have, so here we have this notional, which is iterative. Of course, every month or every year, this will be changing according to our prepayments, because we will prepay our outstanding notional. And also there is, of course, the type here. We could have also this psi function depends on the rate that we have, a fixed rate of the mortgage. So this is also included there. But here, this fixed rate K does not really play a role, because we are interested in stochastic part. So this function psi lambda t, this will be defined. So this lambda ti, so this psi is defined as a mortgage type. So this is what we know. Lambda ti is defined as a function of our refinancing incentive. So then we talk about those coefficients alpha 1, alpha 2, and 3, and so on. And those will be based, this refinancing incentive will be based on our historical data estimation. And this refinancing incentive will be based on market conditions. So this will be based on this function epsilon, and epsilon is defined as a difference of our old mortgage rate, so the mortgage that we already have, and the possible new mortgage rate that we may obtain if we would refinance our mortgage. And of course, here we would define, given that, we would decide to prepay or not. But also you can think of the terms of refinancing your mortgage. This means you close your mortgage and just reopen a new one with the lower rate. But of course, in that case, you may also have some additional penalties included in this kind of transfer. So here we see, so now we have the whole chain of dependencies. So you see, we start with epsilon, where we have this will be kappa. As you remember, this was our swap rate at time ti, and then we have this additional zeta, which was the maybe nicer zeta. This. So we have a zeta, which was this liquidity risk. So those are, you see, market observables. So we have this epsilon. Then we take this epsilon in the refinancing incentive in our logistic function. Then we take this refinancing incentive, and that will be our function for prepayment rate. So that will be our sigmoid function. Then we take the sigmoid function and we use it in the type of a mortgage we have. And then via notional, this goes back to our pricing equation. So essentially, that's it. So we have all the ingredients, we have all the dependencies between a client's behavior, market observables, and type of a mortgage. And now we just need to evaluate this expectation. And of course, as we mentioned before, that we can still divide this expectation, can go under the summation sign. However, we cannot really decompose any more LIBOR rates in notionals, because notionals will depend on the swap rate, and swap rate, it is not independent of the LIBOR rate. Swap rate is a function of LIBOR rate. So then you cannot really decompose the two. And of course, you can say, let's assume independence, but then you're missing the whole idea, whole principle, whole essence of the pricing of this derivative. So imposing independence would be highly not recommended unless you have performed really good studies and you understand that the impact of the correlation of these two quantities, it is acceptable. But I would recommend that just in this case, perform Monte Carlo simulation and just do that accurately. So this is it. So this is how the whole process works. You see, every individual step requires quite some effort. First, we need to know how to price a swap rate. We need to estimate our refinancing function. We need to construct our function psi depending on type of mortgage. And then we have to adjust our notional. So we see, in this case, actually, we can, in the next block, we will be simulating notional as the function of the different refinancing incentives in different swap rates. And we will observe how this notional actually behaves in time, depending on the type of mortgage we have. Of course, in the end, if you like to price this index amortizing swap, we have to plug it into this pricing equation and calculate the expectation. So this calculation of expectations. This is rather straightforward, and actually this is your also homework for today's class.